Hello everyone, welcome to another episode of the Money Method. Today we will cover how to make easy investments in international markets. Basically, we'll be focusing on mutual funds that let you invest outside of India. So in this episode, we will cover why we should do international investments, why choose some international mutual funds, what are the different types of funds that are available for investments, and what are some best recommended funds to invest in. If you're interested in direct stock investments, I have made a different video on how you can invest in US stocks. You can click that and check that video out. In this video, we are covering international mutual funds. So why should you invest outside of India? There are three main reasons why you should look at external investments. One is diversification, the other is better returns, and obviously there is also a bit of currency risk hedging that you can do. Diversification is essentially not putting all your eggs in the same basket. We do that in our general investments, where we don't put all the money in equity funds. We also put some money in gold, some money in debt funds and stuff like that. Similar to that, what we're doing is that we're putting all money in one country. What that means is that essentially we are not diversified for international risks. So in case there are issues like political issues in the country or economic issues in the country, then because our investment is not diversified, we are taking a lot of risks because of our investments in a single place. So international investment lets you diversify by putting some money of you outside the country. So it is generally like good to put like 10 to 20% of your money in international funds or funds outside of India, so that you're diversified against risk. So if you look at how Dow Jones Vs Sensex have performed over the past few years, right? If you look at the last 10 years, they have been pretty divergent. There have been times when Sensex has outperformed the Dow Jones, and there have been times when Dow Jones has outperformed the Sensex. While Dow Jones has generally done better than Sensex, even if you look at like a diversification point of view, it makes perfect sense to invest. Another example is like the NASDAQ versus NIFTY. If you look at the past 5 years, their trajectory is pretty much similar, but the growth rate of the NASDAQ has been phenomenally much higher than how NIFTY has performed. So you can also look for like better returns by putting money in NASDAQ instead of NIFTY. Right. So it's not that you put all your money outside India, it's just that you take a little bit of money there for some diversification and some additional profit. The other thing that people generally talk about is currency depreciation. So if you look at the US dollar versus INR, if you looked at the rates in 2015, the one USD you could get for 64 bucks. Today you have to spend close to 75 rupees to get one USD. So 5 years back, if you bought $100, right, for 6,400 rupees, today the same thing, if you had not even invested in anywhere else, right, it would have got you 7,500. Now think about it. Now you are investing in dollar somewhere, so dollar is growing, so is your investment growing. So that is a way for getting additional returns. Now let's understand what are the different kind of funds that are there. Right. So one kind of funds is essentially feeder funds. This is basically that funds that pull in money from some local investors and then put that money into a global fund. So essentially, Franklin Europe Growth Fund is an example. So they create like a feeder fund in India to collect all the money from Indian investors and put that money into the European Growth Fund. Similar to India, they would have like different countries in Asia, where like Sri Lanka or somewhere, where they will collect money from that local country investors and then put that into Europe. So essentially, this is like a feeder fund puts money into a master fund. You are essentially purchasing units of a different mutual fund. So it is very similar to the fund of funds that are there in India. Another type of investing is index investing, or investing in ETFs or index funds. So these funds don't specifically choose which stocks to pick, they just follow an index. So there are index funds that track the S&P 500 or the NASDAQ 100. There are also ETFs that track the Hang Seng. So these are essentially taking the top performing stocks of specific indexes and they are actually following that. This is pretty easy to invest in indexes because you don't have to worry about like specific stock risks. That sort of a diversification, and you're actually picking like the best stocks for that country or that index has to offer. Another investment is the active funds investment. These are essentially those mutual funds that pick and choose which stocks to invest. Now they are like the fund manager sits in India and he chooses, let me put money in say Microsoft or Tesla or Amazon or Facebook. These are classified as sectoral or thematic funds, and the choice is made by investment manager sitting here in India. Now that we have learned about different kind of funds, let's see how some examples for different funds that could be invested in, what sort of returns they have and all that. A phenomenal performer has been the NASDAQ 100 ETF. It's an index fund on US stocks, which it basically tracks the NASDAQ index. The 1-year return has been close to 45% and 3-year annualized returns has been around 28%. There are some other investment opportunities like China, which have outperformed, like the yearly return is 52% and the annualized return is around 21% for the past 3 years. I wouldn't recommend going into Chinese investments because there is a lot of clout over China and different countries are not in a good state. The macroeconomic situation doesn't look good for a Chinese investment, but definitely looks great for a US investment. There are also some funds like the Aditya Birla Sun Life Equity Fund. They actually put money into different markets. They put some money in US, some money in Australia, some money in Europe. They actually pick like the best of the stocks worldwide. They have been given consistent returns of around 12% over the past several years. So it's like stable returns plus like a complete worldwide diversification that you get. So choose funds that are on countries that you feel are doing well, right? So US is a good place to go into. China maybe not so great, or look at funds that give you like best of multi countries. Some funds to avoid, before getting into funds to avoid, a personal investment that I have done is on the DSP US Flexible Equity Fund. I have put like a SIP on this from past few years. It's been doing pretty well. So this is another active fund that invests onto specific stocks in US. Some funds to avoid are essentially the HSBC Brazil fund. Brazil is a country that has been doing pretty badly. There is like a lot of corruption and a lot of issues in the country domestically, right? So it was once an active emerging market, but now it's a place where you would rather not put your money. The 3-year annualized returns have been close to flat, and the last 1 year it's been down 24%. Europe isn't doing well either. There are a lot of issues on the Eurozone with UK not being, the whole Brexit stuff and everything. So Europe isn't a good place either. And then there are some international investment funds which are feeder funds which are putting money in not so great stocks. So when you're looking at like a feeder fund, look at which funds these are putting money into, right? So if they're not putting into the place where you want the money to go, so it's better to avoid those kind of funds. That's what we had today. Hope you learned something that would help you choose some profitable mutual funds to invest in. Thank you, and please subscribe for more such content from the Money Method.